We were talking to some of the companies involved in cosmetics. They said because of selfie cameras and social changes, like people posting a lot on social media, their pictures and all, cosmetic sales have moved up globally as well as in India.
In the trends framework, right? Walk us more through what it is.
Technology changes, regulatory changes, economic changes, sustainability changes, demographics and social changes.
Are we headed for a correction or are we headed for a next boom?
Corrections in a bull market come like a thief in the night. You cannot time it. Do a pre-mortem. Think that, okay, I'm in the future, say we are in 2027. Imagine you went wrong. The risk of an investment, it strengthens your investment case. If you go to casinos and see gamblers typically keep money into mental accounts. Suppose the person has got 10,000 rupees through the casino and won another 10,000 rupees. The gambler will treat those two amounts very differently. And people will take more risk with their profits.
An investing mistake that you still make.
If we pool in all the mistakes that typically investors make, I think I would have done all of them.
Successful investors in 2035, 10 years from now, will be the ones who have cash. Hi everyone, welcome to another episode of Power Talks. Today we have with us someone who has more than 2 decades of investment experience. Nimesh Chandan, the CIO of Bajaj Finserv AMC. Nimesh, first of all, thank you so much for taking out the time. Let's start with, the key thing that I found very unique in Bajaj's investment philosophy, which is behavioral edge. And, as you often talk about, that investing is more about temperament and not the knowledge. Let's start with that. What's your take on A, what that is? And second, was there a point in your personal journey that sort of triggered it and made it real for you?
We truly believe that temperament is more important in investing. You may collect information, you may have models processing that information better, but then your reaction, your decision on it should be unbiased, or your emotions should not get involved in taking that decision. So those lead to the right decision. I think Benjamin Graham wrote it way back in 1950s that temperament is more important than knowledge. For personally my case, actually I started my career as an IT analyst in the year 2000.
Okay.
By 2003, very few remember that the bellwether Infosys at that time, on April 10, 2003, the stock crashed by 40% in a day. And I was the IT analyst at that time, and Infosys had revised the guidance downwards and people were disappointed with the numbers. So 40% down, it's on a lower circuit. And some of my colleagues came to my table. And I remember one of them asking me, "Ab kya karega tu? What will you do now?" I don't think the world requires an IT analyst anymore because the bellwether has crashed. And I was scared at that time, truly, about what should I do in this. And just 3 years into this, I have only been a bear market analyst in a way for technology, with 2000 being the top. And from there, I saw Infosys actually becoming a multi-bagger. So whoever bought on that day saw returns which were spectacular. By December, I think the stock was up. It had covered all the ground, and then it became a multi-bagger from there. So it taught me a valuable lesson that clearly people react with greed and fear. Everybody has the numbers, but very few would have bought that day. And that's why I think behavioral edge, I realized that is more important to have than just an information edge.
Right. But very curious, right? How do you assess it, right? It's very subjective. So how do you sort of bake into a model, right? It's not bakeable. So how do you plan that?
So it's not easy, but it's not impossible. There are several research tools available for you to help you control your own biases and emotions, and help you take advantage of the crowd's biases. So I say behavioral edge is a mirror as well as a lens. It helps you identify your own biases. There are tools available to do that. And of course, you have to implement them with discipline so that you are de-biased. Or the second is there are studies available that show you where potentially the crowd has acted in greed or potentially it has acted in fear, and you start taking advantage of that. Some research is way back in 1980s, which we use for screening these ideas. So There's a study done by Richard Thaler and DeBont. Do stock markets overreact? And it's a beautiful paper where they have actually shown that how over 3-year and 5-year period, stocks reverse. There is a reversal pattern where people become most greedy. Those revert to the mean, and where they become more fearful also revert to the means of basically underperformers do better than outperformers. So once you kind of map the cycle of the market and with some study of history and some experience, you can develop tools which screen for you some of these ideas. So that's what we use. We use some of the behavioral screeners to help us do that.
Very, very interesting. And I'm curious, right? As a retail investor, right? How is there some framework that you apply in your, say, personal investment philosophy that I can also do? Because of course, it's very easy to get jittery when the markets, go down, and the current, I would say, second half of 2024 was a classic example where markets were choppy and then people pulled out money. What would be your advice to them?
I would suggest that anybody who's coming into investing and wants to do it more seriously, they should look at 4 different fields to learn from. You have to learn about history. You have to learn about businesses. You have to learn about market concepts, like how does valuation actually take place for a business. And 4th, most important, is psychology of the market. So if you put these 4 together and you understand the cycles of the market, then you can be a better investor.
Right.
So awareness about these concepts, I think, is important rather than just looking at the ticks on a daily basis or just taking all the noise that is bombarded to you every day.
Right.
So if you do these establish these 4 subjects as, okay, I understand them now, and then step into investing, your outlook or your view of daily movements is very different.
Yeah. No, I think important point here, right? To understand what you're investing in, all the 4 pillars are very important. But a lot of the retail investors, right, and I'm coming from the lens of our audience, we have seen like a bull rally last couple of years, right? And when things go south, you start getting more jittery. How do you sort of maintain your behavioral edge in those cases? What's your framework there?
So there are simple tools that one can use, and as we go through the interview and this podcast, I can highlight more of these. These are tools actually which at least I have taken from different areas of decision making. So for example, we use an investment checklist.
Okay.
It's a simple list of things that you must know before investing. About the company or about the asset or about the market. Some people who are investing in mutual funds, they can have a simple checklist of things that they want to look for while investing in a fund or so. So we do it for our investments. So whichever security we want to analyze, we have this checklist of, say, about 70 questions, which tell us that these are the things that you need to check and have the information in your hand before making the decision. Many people who get into decision making before checking this list then suffer an endowment bias that I have bought it, so it's nice. So even if you later on you realize there's something wrong with it, you don't want to part with it or hit a stop loss. So I think investment checklist is one such thing. The second thing is do a pre-mortem where you actually think that, okay, I'm in the future, say we are in 2027. And I'd taken a decision to invest in this security or asset in 2025. Imagine you went wrong. Like that stock is down 40%, 50% in 2027. And then write down what could be the reason that can happen.
Okay.
Now that highlights the risk in the investment. Now you're aware that what can be the risk. You can also imagine that in 2027, this investment has given fantastic returns. And what could be the reason for that? So you created a bull bear case scenario. You did a pre-mortem. Then you are prepared with what are the risk rewards in the investment that you're making. And I think knowing the risk of an investment, it strengthens your investment case. Because now you know that if this happens, I need to get out, I need to hit a stop loss. A stop loss is a kind of a pre-commitment you make. That if this happens, I will get out. Because many people persist or continue investing in something that they hold. Even if the initial case for investing in that security is gone, they hold on to this with hope
Yeah.
That maybe when I break even, I'll get out, or maybe something good will happen now after going through a bad patch. If you're holding something on hope, then you're making mistakes. So there are tools, simple tools. Pre-mortem was taken from a decision-making paper by Daniel Kahneman and Gary Klein. Checklist we have taken from actually Dr. Atul Gawande's book on hospitals. It's called the Checklist Manifesto. We've taken some inspiration from airlines using a black box. So we write a journal, which we have taken inspired from black box in airlines. So we have taken tools from decision-making areas where decision-making is very critical and see how that field is done, and see we can imbibe it in our investment business.
Very, very interesting. A very methodical way, right? I think you rightly said around, writing down the risks just make you much more aware about the investment, and having these stop losses and these checks and balances sort of helps you not get jittery, right? Usually in mutual funds, right, it's often said, invest for the long term. But from your perspective, right, and because you talk about things can also go south, what is long term according to you?
I think 3 years and beyond is ideally long term. Today, after 330 is long term, but unfortunately, 3 years and beyond is your long term. Not that you don't review your portfolio or asset allocation or keep a check, but don't keep it too short. Many a times what happens if you have a check, say every month, slowly your investment horizon starts shrinking to the review period. If you're checking every month or every 10 days what my portfolio is doing, the values that you have of investment will get diluted. You will then start looking at, okay, what are the short-term movements? And in the short term, there is a lot of noise.
Right.
Even good businesses, good companies can go through a short-term patch where either the stock doesn't perform or the bond prices don't change or so. So it should not disturb you. So keep a sufficiently reasonable review period. Think longer term. Don't stop the process of compounding. Ideally, if you see in mutual funds, at least, we did a study on Nifty and Sensex, and we saw that if you have an investment horizon more than 10 years, you're through. So there is hardly any chance of a negative return. If you make it 15 years or so, then you're cleanly through. So there is, I think 10 years plus, investors generally, if you have selected your asset right, you don't have a bad experience.
Fair. And since you talk about, selecting the right assets, let's move to the trends framework, right? Which I think you spoke about in multiple places. Walk us more through what it is and, how that helps in picking the right sort of sectors and stocks.
Mega trends are long-term changes that benefit certain companies, businesses, economies, and they are against certain companies, businesses, and economies. So here you choose companies that benefit from these trends, and they have a tailwind for growth, potential for growth. Then you have to analyze whether they have the ability to grow. They have the ability to capitalize on that trend. So we identified 6 sources of trends. So for simplicity's sake, we put it as TRENDS. Globally, there are other models or short form to it, TESTIL or something like that. But he said, in simple terms, there are 6 sources of trends: technology changes, regulatory changes, economic changes, which are as the country grows from emerging market to a developed market also, nature or sustainability changes, demographics, your aging of the population, the income equality in the population, and social changes, where customer behavior is changing. So these are the 6 sources of trends. There may be some trends which have a combination of one or more, 2 or more trends. So we try to identify those and then extrapolate them and identify which businesses have a potential to do well.
Got it.
Now, with cameras, for example, mobile phones, the selfie cameras have become better and better with every generation of phones that have come. We were talking to some of the companies involved in cosmetics. They said because of selfie cameras and social changes, like people posting a lot on social media, their pictures and all, cosmetic sales have moved up globally as well as in India.
Interesting.
Now, that's a trend that you suddenly realize, okay, because of a selfie camera, you're seeing cosmetic sales go up. And then you identify companies that benefit from these and see if you can get something at the right value.
Very interesting, joining the dots, right? Like something from a social media to cosmetics. Absolutely. Right. So very interesting. And using this framework, Nimesh, what is on your watch list for 2025, if I were to ask?
We monitor a lot of these trends. So we have identified 8 or 10 trends which are very important for that. If you see, the power intensity of the economies is going up because of the changes that are happening. Like I mentioned, electric vehicles is one change. Gadgets that we are wearing, we are charging it all the time. Data centers are like power guzzlers. So we identified power sector as one of the trends, and we then identified where in that entire chain of the power sector, whether it's an equipment supplier, utility, or like somebody who's a consumer. The other trend we see is consumption, which we see as a long-term trend, where as economies cross a certain threshold of per capita income more than $2,500, the discretionary spend starts going up.
Right.
And India is seeing that change. In the last 2 years, we are seeing that change happening, and that lasts for a very long time. So if you look at countries which are like, for example, US or China or some of the other developed countries, there is an inflection point here. So now, which are the companies that can benefit from discretionary consumption? So those are the list of companies that we look at. So we identify these and see which companies stand to benefit, and try to place ourselves in the right spot, hopefully, to pick up them. So there are many in the infra, in consumption, in manufacturing. We publish that in our portfolio. So like, any of your viewers can have a look from our website on which are the trends we like and which are the companies benefiting from that.
Yeah, absolutely. Very interesting how, things sort of make sense when you start joining the dots, right? But at the same time, when we look at sectors or themes, right, where does valuation play a role? So, for example, there was a time everyone was following defense or PSU as a sector, and then they sort of didn't do that well. So, if I were to identify a particular trend, right, how do I bake into, is it currently fairly valued? What's your take on that?
So you want to be in a trend in more like a growth path that it has. So there is a time when the trend is just forming. At that time, you may not know which are the companies clearly benefiting from that trend. So it's an initial phase where the trend is developing. You may not have a big set of companies that benefit also from that trend. It's just starting off. Then comes the growth path, and then comes the maturity, where people have taken it into estimates. Valuations also discount what trend that mega trend is, and it's actually time to take some money off the table. So there is this 3-part journey. You want to ideally capitalize on the middle one, which is the growth path, and that's a fairly large, multi-year part that you want to benefit from. Some mega trends have sub trends that come in and out.
Okay.
And that's where valuation becomes very important, because if people get excited about a trend very and push up the prices very quickly. See, many a times, like for example, themes like defense also, there are very few stocks which are part of that trend. Say 10, 12 pure defense plays, and then maybe some ancillary ones. But when people get excited about that, when it is discovered, that trend, the valuations shoot up to very high level.
Right.
And multi-year growth that you are planning to invest in gets discounted in the first year itself. That's where valuation becomes important. It tells you that, see, the people are very excited. They've factored until 2030. So you may not get that upside from here. So valuations tell you whether something is discounted or no. We use valuation to put the right weightage of that security in the portfolio.
Okay.
If the valuation is attractive, it comes at the top of our portfolio with a high weightage. If the valuations have been discounted to a large part, then it comes at the bottom or in the middle of the portfolio, where we know that, okay, much of it is already discounted, so we need to be a little careful. From there on, only if we get a new surprise or a reconfirmation of that, we will increase that position.
Right. And, I'm personally also very curious around how do you assess that, okay, this is a very high valuation. Like, one is, of course, you compare it with how the industry PE is working. But just wanted to pick your brains on how do you do that as a company and even in your personal investment.
So it's behavior. 2-3 different tools that we use. See, by discipline, where you are looking at what to invest in and when to invest in, is slightly easier. I'm not saying it's easy, but slightly easier than sell discipline. Sell discipline, what to sell and when to sell. I think it's like, not very clear. When valuations are attractive, it's a clear buy. When valuations have moved up, is it a clear sell? We typically believe that you should not sell if the valuations that you're targeting have moved up slightly higher than what your estimate is for a temporary basis. You should not.
Okay.
Otherwise, you will miss out on a good long-term story just because something went up a little bit away from your valuation. But if the high valuation is combined with something, like for example, it's combined with a negative trigger, either the earnings growth is not as much as you expected, or there's a business change or a management change that has come. If it's a combination, high valuation and you've seen that change, then it becomes a sell trigger. If high valuation is combined with, okay, now I have a very identical good replacement available at a lower valuation, then it becomes a sell trigger. So valuation ideally should not be your only thing for selling. It should be something where you mark that set of companies, that these are the ones I need to be closely watching. But you sell only when 2 or 3 other triggers come in, like if there is a downgrade, if there is a management change, if the good replacement is available. And sometimes, if it has become a very large part of your portfolio, and for risk management sake, you are trimming something.
Got it.
So, but we use many tools for that. We use bull bear case analysis, where we actually create a bull case that if future unfolds much better than what we expect for that company or business, what kind of valuation it can go to. So we monitor not only the base case, but also the bull case where it is. We keep certain pre-commitments that if there's a certain change in our outlook, we trigger a stop loss or a change. We use some of these screeners by Richard Thaler and DeBont and Jagdish and Titman to identify where in the cycle that company is. Sometimes the euphoria can take it much higher. That is where a little bit of experience and art part of the investing comes in, where you have to take that subjective judgment as to when to sell and how much to sell.
Right. And I think that's a very detailed framework. Is that the same that you also apply to your own personal portfolio? Like, how does that look like?
Personally, I invest for a longer term only. So there are many years that I continue to hold those investments. Obviously, if nothing was going wrong in them, but I hold for multi-years. It has become more like muscle memory now for me to keep looking at these tools to see even if at a personal portfolio level I have to change anything.
Got it. And how does your portfolio look like? Are you into mutual funds, stocks, like at an allocation level?
So now majority mutual funds. So for many years I've been only investing in mutual funds, and the ones that my company manages, that's what we do.
Got it. And you spoke about a lot of researchers and economists and their workings and learnings, right? Is there something that you have along the way sort of imbibed in your own investment journey, and one thing that you sort of went against with and made your own framework?
So a lot to learn from many of the thinkers. And as I said, we actually take inspiration from many different fields. So it's not only just behavioral finance. We take ideas from many fields. Obviously, everything is on the foundation of a behavioral edge, that you need to do better, you make better decisions. So we've taken ideas from, as I said, many areas, many researchers. Differing from these Nobel Prize winners and the guys who put their life into it is a bit difficult. There's only one area where I kind of had a different view. People I follow very ardently, like Richard Thaler or Daniel Kahneman. This is regarding the value of expert intuition in the Indian markets.
Okay,
that is the only place I differ. So Herbert Simon said that intuition is recognition. So for example, you go to your family doctor regularly, and there are times when just looking at you, the family doctor knows that, what's wrong with you.
Right.
Sometimes the intuition is where your spouse calls up, and from the hello, you kind of know whether it is good news or bad news, right? But that's an intuition. Psychologists say there are two systems of thinking, system 1 and system 2. System 1 is very spontaneous and quick. So when somebody throws a ball at you and you duck, it's system 1. You don't wait to calculate the trajectory and the speed. System 2 is more deliberate, elaborate, where it does a lot of processing. So if you are multiplying 19 multiplied by 27, so now your system 2 is working. It's not a natural quick answer that comes in. Intuition is actually when you're repeatedly you are seeing certain patterns which are processed by system 2, but then you make a mental model and put it into system 1. Okay, so now you act with intuition. In markets also, the patterns are repetitive and human nature makes those patterns repetitive. The exact number may be different, but the patterns are similar, and you can be trained to recognize these patterns. So that's why sometimes you find traders, by just looking at the screen, they say, okay, something has changed. Right now, there's something wrong that has happened in the market, or something good has happened in the market. You saw a blip somewhere. Fundamental analysts, when they meet a management and hear the narrative, what they're doing with the business, they also have an intuition. Okay, I have tracked some of these companies earlier in my career, and I can see something similar happening here, and there's a potential there. So expert intuition, I think, works, and it is about expert, not it's about experience. Some people have experience, but they've not learned from the experience. And expert intuition is when you've seen patterns, you have tested them, you've got a feedback, and you have learned from them. So that's where I believe that, or I differ from some of my gurus, is that I believe some expert intuition works in picking investments.
Interesting. And on that, I would love to have your view on, because we are talking about patterns, right? And the whole surge in markets has been post the COVID boom. Like they've rallied, and so many new investors have come in. But if we were to go back, there is a cycle. Markets does come down and then go up again. So what do you think is ahead for, the Indian retail investors who has entered in the, say, last 4-5 years?
So there are 2-3 things that typically new investors or biases, or maybe patterns that they display. Number one, most of the people open a new account for buying, right? Nobody opens there will be hardly few people who open a new demat account and a brokerage account to actually short the security or sell in the future, the buy a put option, right? So most of the people come with a buy bias. That rising market attracts people in. They come determined to buy something. Okay, so that is one thing we've seen after COVID. People come in to buy, and there's a surge of new accounts and new investors coming in. Second, they come with a recency bias. They see last 1 year, oh, fantastic return. So they come with their expectation that the same return will compound. There is something called a base rate neglect. Nobody sees that Indian markets over, say, a long period of time have given a compounding of about 14 to 16%. But if they see last year was 60% return, they come with that expectation that next year also will be very high return. They don't actually look at, okay, it's 14 to 16% compounded, so you may actually see a dip also. So that's something that they are not prepared for. Third impact is the house money effect. If you go to casinos and see, gamblers typically keep money in 2 mental accounts. I tell people that they keep money in 2 different pockets. In one pocket, they keep the money that they have brought to the casino. In the second pocket, they keep the money which they have won by playing a few games at the casino. Okay, suppose the person has got 10,000 rupees through the casino and won another 10,000 rupees. The gambler will treat those 2 amounts very differently. And people will take more risk with their profits. So then you will take a bet, okay, this is a profit. Anyway, I'm not losing my money.
Loss of capital is
exactly. So people try to take more risk when they have immediately made some money. Think about it. People who came during COVID time when they saw 2-3 years of fantastic bull run without a correction coming in, or so maybe a very small correction coming in, they will take higher risk then. Or they tend to take a little higher risk. Wealth creation is not made by just taking higher and higher risk. You can't be treating the 10,000 rupees separately. You have to keep them together and be as diligent in putting the next investment as you were when you put the first investment. Or probably with more learnings also.
Fair. So, with, coming back to the whole pattern of market, right? And, we were talking about the trend on consumption and overall the India growth story. Where do you think, with people fueling in putting their money in the markets. Are we headed for a correction, or are we headed for a next boom? What's your view, like more short term and long term?
I think it was Robert Schiller who said that corrections in a bull market come like a thief in the night. You cannot time it. And correction is a characteristic of a bull market. People should know bull market is not something where everything is going right. Something or the other keeps coming. Even if you see the bull market between year 2003 to 2007, there were several corrections and some were quite severe correction. I remember when May elections in 2004 results came in, the market was on two down circuits. In 2006, when Fed was increasing rates, Sensex had come down from about 12,500 to 8,800. So it was a severe correction. So corrections are part of the market. Now, whether you take this as an opportunity or you worry about it. Some people keep waiting for a correction. And as I said, it's very difficult to time it. If you got it, it's very lucky. Some people try to sell now thinking that they would rebuy in a correction. That's also dangerous because you require two correct decisions, right? You need to sell at the top, and after the correction, you need to buy exactly at the bottom. If you're wrong in one of those two things, you've just paid transaction charges and taxes, right? So you have to be very accurate in two connections. Now, for a long-term investor, I think, and especially when a country like India, where the fundamentals are strong, we are seeing good growth, many quality businesses available for investing. You have to obviously look at the right valuations and go for those segments. But there's an opportunity for investors to create long-term wealth in equities. Keep your expectations reasonable. Use the dip or a correction to add, whether you top up your SIP or add a little bit to your investments. I think that's the way you will make money. We are very bullish on equity markets. And we believe that India is always a buy on dips kind of a market.
Yeah. And I think fair point. And, I've been doing this for a while now, and all the different perspectives that I get, right? And I think the end story, it's 20 years, 30 years down the line. If you look at a long-term horizon, you're always for a win. So don't try to time the market is what the essence becomes. So, I think, again, recency bias from my end, and, because we're in a bull phase, and a lot of our audience is also more, I would say, recent joinees in the, markets. Usually it's said that bear markets sort of teach you more than the bull markets. Any example from your personal investment journey that sort of can help our audience to learn from the probably a mistake that you made?
So in the initial years, I have made all kinds of mistakes. Any investor, if we pull in all the mistakes that typically investors make, I think I would have done all of them. You learn over a cycle. And there were times when I used to also be worried whenever there is a correction, sell something out of fear, buy something out of greed. Like, this is the next thing to buy, and you pay crazy valuations for it. What helped me, I think, or what I devised after that was keep a framework, keep a system, and follow it with discipline.
On that note, Nimish, I have a quick rapid fire. I would love to ask you a few questions. So very quick.
Not very difficult ones, I hope.
No, it's just easy ones for you. Okay. So one book recommendation that you would have for all Indians.
The Most Important Thing by Howard Marks.
An investing mistake that you still make.
Confirmation bias. I like to meet people who say I'm right.
Okay, good to know that never ends. One favorite stock based on fundamentals.
I won't say stock because I don't think I have favorite stock or something, but because I've been tracking IT since the time I started my career, I keep a keen eye on that sector, even when my colleagues are handling.
Interesting. And in the recent light as well, I mean, the IT in the light of AI.
I keep track of everything that's happening there.
This one is interesting. One market belief that you have changed over the last 5 years.
At least in the recent past, I think tracking politics and geopolitics is also becoming important in investing. More government interference these days in global trades and businesses.
Fair. I think as the boundaries get blurred, something happening in US starts directly impacting. Cool. Last one, fill in the blanks. Successful investors in 2035, 10 years from now, will be the ones who have dash.
Stayed invested.
Fair. I think the right note. And I had such a wonderful time, Nimesh. Last question to sort of wrap this up. We started with behavior's edge, right? I think I would end with what's that one advice, one framework that you would have for our audience out there who is in their mid-30s, investing for the long term, eventually becoming financially free. How should they maintain their behavioral edge?
Okay, I'll say a few things that I think help being successful at investing and creating long-term wealth. Number one, focus on the long term. You are running a marathon, not running a sprint. Invest as if you are investing in a business rather than the stock. Have an investment checklist for identifying what are the qualities of an investment that you are looking for. Understand the risk of what you are investing in. Maintain an investment journal. See to it that you write down those decisions so that when your mind plays games with you, right? When you actually see something doing very well, your mind will say, "Oh, I always knew. I'm an expert at that." And when something goes wrong, you blame luck. It was not my fault.
So true.
So learning from that is important. Asset allocation helps because every asset market gives an opportunity to make good money. So keep a good asset allocation and stick with discipline.
Perfect. I think perfect note to end this, and I will be on the lookout and hopefully, be able to sort of compound my wealth.
It was a pleasure talking to you. Thank you for the very interesting questions.
Thank you so much, Nimesh.